Now, when a particular thing is manufactured, as I said, the entire cost of production is giving me the factor cost. But when it is sold in the market, sometimes taxes are levied on those commodities that are called as the net indirect taxes. This net indirect taxes will increase the price of the commodity, but sometimes a subsidy is also given to a commodity. Subsidy is the cash relief which is given to the consumer by the government of India. For example, say the mother dairy milk is, though it is of 28 rupees a litre, but 1 rupee subsidy is given and it is sold at 27 rupees. So, the subsidy is of 1 rupee. Most of the time the petrol, the diesel, the gas all has a subsidized price. That is, the government has shown some kind of interest in bringing down the prices in the market. So, the factor cost and the market price vary because here whatever is just the cost in production is to be added, but here it could be either the net indirect taxes which will increase the price of a commodity, or the subsidy is to be subtracted which will reduce the price of a commodity. So, the market price, we have to see that either the indirect tax or the subsidy is to be calculated accordingly to get the market price of a commodity. Well, then there is net factor income from abroad. Net factor income from abroad is in fact the factor income which is earned from abroad and by the NRIs, that is the factor income of the NRIs in the domestic territory. Whatever is being earned by the Indians who are not staying in India and their income is coming to India is the net factor income from abroad. That is, they have not made that income, they have not earned that income in the domestic territory, but it is coming to the territory is the net factor income from abroad. Now, when I have to calculate the national income of a country or the domestic income of a country, I have to keep in mind this factor. When it is national income, I have to calculate both the incomes generated in the domestic territory and also those which is coming from abroad, that is the net factor income from abroad. So, the national income will be domestic income and it is in addition to the net factor income from abroad. That is, whatever income is generated within the country and whatever is being earned from outside gives me the national income. But when I have to calculate the domestic income, I will be calculating national income minus the net factor income from abroad, because this is the net factor income from abroad is not the income which has been generated in the domestic territory. So, it is not to be calculated in the domestic income. Therefore, this national income, which is inclusive of both the incomes, the domestic and the net factor income from abroad, so we will calculate it by saying national income minus net factor income from abroad. One having both the incomes, the other one is being calculated only on the income which is generated within the domestic territory of a country.